BTEC Unit 2 Finance Topic Questions. This presentation is going to look at the topics that you may be asked in your BTEC First Award Unit 2 Finance exam, breaking down the questions topic by topic. This short video contains a series of questions and answers related to the topics of business finance. This has been designed for students sitting the BTEC First Award Unit 2 Finance exam. However, it will be useful for any students studying financial concepts as part of their course. Simply to remember to pause the video on the question screens, complete the questions, and then unpause to get the answers. This should be an excellent quick-fire revision resource to develop any areas of weakness. Don't forget you can get more resources and quizzes online at BeeBusinessBee.co.uk. Also, don't forget to follow me on Twitter, it's at BeeBusinessBee, and subscribe to my YouTube channel, BeeBusinessBee. Okay, let's start with our first topic. Startup costs. Define the term startup costs. Give examples of startup costs. Explain why a business may have startup costs. Pause the video now. Define the term startup costs. You could have said startup costs are the costs incurred when starting up a business or setting up a business. You could also have said they are one-off costs that only happen when setting up a business. Give examples of startup costs. Well, I said the word example, so that means more than one. So you could have said a shop sign, a till, shelving, fixtures and fittings, a license if you need one to operate your store, legal fees for setting up the business, anything you want as long as it's a one-off cost for the business. Any answer will be valid as long as it fits in with the example, the business you may be given in the exam, and it's logical and you can justify it. Notice that typically I'm going to say a long way through this exam that most of the questions you get, there is no right or wrong answer. It's going to be how you justify it that makes a difference. Explain why a business may have startup costs. A possible answer could be a new business will have startup costs as these are the one-off items that are needed to set up a business. Spending on these items will help the business to become operational and to start making money from the business. Notice the word explain. Explain just means tell me why. You just got to tell me why that answer is valid. Why is it logical? And all I'm saying there is that you need to spend money on startup costs. You need to make your building look presentable so your business appeals to customers. Otherwise, nobody will come to your business and nobody will spend money. Okay, hopefully okay with that. Let's move on to the next questions. Operating costs. Define the term operating costs. Give examples of operating costs. Suggest some ways a business could reduce their operating costs. Pause the video now. Let's look at the answers. Define the term operating costs. Operating costs are the costs incurred with the day-to-day running of the business. These are the day-to-day running costs of the business. Either of those would be a valid answer. Give examples of operating costs. So again, that keyword examples. You could have used utilities, so that would be your gas, your electric, or your water. You could have put them separate, or you can categorise them together. Wages. Remember, that's a variable cost because it's paid by the hour. Salaries. So you could have done a salary, which is a fixed cost, remember. Rent. Stock, or your cost of sales, you may want to call it. They could all be examples of operating costs. You could have many more, like broadband. So, again, the list is endless, as long as it's a valid operating cost for the business in question. So again, try and link it to the business example you're given in the exam. And the question there says, suggest some ways a business could reduce their operating costs. So some, more than one. As I listened before, you could suggest that they find cheaper suppliers. Now, if the question you want you to discuss, think about what the drawback is of finding cheaper suppliers. And if you're having time in the exam, just add the detail anyway. Show the examiner you know what you're on about if you've got the time. Don't finish early and then just leave your answers there. Go back and check them, and if you've got more time, add in some detail. They could negotiate discount with their landlord. If they're renting a building, they can negotiate discount with their suppliers if they want to, see if they get a discount. They could buy in bulk. The technical term for that is what's called an economy of scale. and you will definitely know if you've done A level, but you don't need to really worry about that. But if buy in bulk, if you buy in bulk, you should get a discount. Or you could maybe possibly outsource your work to cheaper countries. So outsource the work maybe to China or India, where you could take advantage of lower operating costs, and then import it into the UK and sell it to your customers. All ideas that are all valid and all logical. Fixed costs. Define a term fixed cost. Give an example of fixed costs. Explain the difference between a fixed and a variable cost. Pause video now. The answers you should have. Define a term fixed costs. Fixed costs are costs that do not change with output. As simple as that. Give examples of fixed costs. Well, they could be your rent, your salaries, your broadband, insurance. They're all costs that you typically will pay the same amount for. So if you think about broadband, typically it's unlimited. So it doesn't matter how much you use it, you're going to pay the same amount for it. That'll be the same for insurance. So you pay the same amount for your insurance at the start of the year, and it'll carry on throughout the year. Your rent will be exactly the same. You might agree a rental income at the start of the year, and you pay the same amount of this throughout the year. And like a salary, it's a fixed amount everybody gets paid, so you might get £18,000 per year. It doesn't matter how many hours you work. And then explain the difference between a fixed cost and a variable cost. Fixed costs are costs that do not change with output, whereas variable costs do. This means that if a business does not sell any items, it will still have to pay its fixed costs, where it will only pay variable costs based on the level of output in the business, so in the number of items it produces or the number of items it sells. So remember, fixed costs are going to happen all the time. If nobody comes in your shop, you still pay your fixed costs. Variable costs. Define the term variable costs. Give examples of variable costs. Explain some methods a business could use to reduce their variable costs. Pause video now. Variable costs are costs that do change with output. Examples of variable costs include wages, your utilities, so your gas, your electric, or your water if you're on a water meter, the cost of sales, so the cost to make your product or your service, your telephone bill. Now that's because if you use them more, you're going to pay more. So think about the cost of sales. If you sell more items, you need to produce more items, and that's going to cost you more money. Just like the same with the utilities. If you open your shop more hours, you're going to need to use more gas and electricity. Wages, because if you need to employ your staff to work for you longer, then that means more hours, means paying them more by the hour, so they're going to earn more money. So that's a variable cost. Explain, so again, tell me why. Some methods a business could use to reduce their variable costs. A business could look to find cheaper suppliers, or buy in bulk to get a discount. So there's some of the methods I suggested. And I've just developed a little bit further by saying, however, you need to be careful not to damage the reputation of the business and damage any brand loyalty. Didn't really need that. I'm just showing the examiner I actually know what I'm on about. And then I go and make another point now, because I'm feeling like I want to just show that I understand this topic. It could also look to find cheaper utility bill providers or broadband providers, because this would also save money. Again, there are other options you possibly could do to reduce your costs. But remember, the broadband question, I'm assuming there that I'm on a limited package where I've got a limit on my bandwidth. So if I use more broadband, it's cost me more money. If you're using a standard broadband package, the ones that most of us see now, which are unlimited, that wouldn't be a valid answer because it's not a variable cost. So what maybe I should have done there was explain in more detail to show the examiner I actually understand what I'm on about, because it could possibly get confusing. Hopefully you see why I've done that and why I'm showing you how it could easily confuse an examiner who's looking at your paper, doesn't know you, and is making a decision based on what's written on paper. Total costs. Define the term total costs. What is a formula to calculate total costs? And calculate the total cost for the following business. Has revenue of £200, wages of £80 and rent of £20. Pause video now. You should have defined the term total cost as the total cost a business has to pay. The formula to calculate total cost is fixed costs plus variable costs. And to calculate the total cost of the business, you need to ignore the revenue figure because that's irrelevant, because remember, revenue is all the money coming into the business. And you just need to add your wages, which would be a variable cost, to your rent, which would be a fixed cost, and you should have total costs of £100, 80 plus 20. Direct costs. Define the term direct costs. Give examples of direct costs. Direct costs are costs that are directly linked to the production of a product or service. So there's the key word, directly linked to making and producing that product or service you offer. Examples could be the raw materials that go into making the product. Could be your wages, because they might be directly linked to making the product. It could be the packaging that goes into making that product. So these are costs that are directly linked to producing the product. They would not be things like delivery or marketing in general, because they are not directly linked to producing the product. So bear that in mind. This could come up in an exam where you might have to tick the multiple choice options. So which are direct costs? So you've got to ask yourself that question. Are they directly linked to production of the product or service that's been made in the example? Indirect costs. Define the term indirect costs and give examples of indirect costs. We want to pause the video now. Indirect costs are costs that are not directly linked to the production of the product or service. So typically now we're looking at costs that are not directly linked to the product or service being made, but other costs the business may have, like advertising, so marketing, administration, doing your paperwork, the delivery of the product, or maybe research and development, so developing a new product. They're all costs the business will have, but they're not going to be directly linked to making a product or service as such. Revenue. Define the word revenue. Give examples of revenue for a business. What is meant by the term sustainable sources of revenue, and what is meant by the term unsustainable sources of revenue. You may want to pause the video now. Revenue is defined as all the money going into the business. If you find it hard to remember, think of the word how it sounds, rev-in-you. So in. Even though it's spelled with en, think about the in bit, rev-in-you. In, going in, money going into the business. Give examples of revenue for a business. So you could have sales revenue, so that's all the money you make when selling products. There's a clue in the word, sales revenue. You could have the owner's personal investment. That could be a form of revenue, money going into the business. But remember, that's not sustainable because the owner can't keep putting his money into the business. Share capital. So that would be what the shareholders put in. Remember, the word capital is another word for money. And we know that shares from our first unit are what companies sell to try and raise money. So you could be a shareholder. So if you buy shares in a company, you're giving them share capital. It could be from investment, so money that's been invested in stocks and shares and they've sold it themselves. It could be from a bank loan. It could even be from a subscription. If you've got customers subscribing, that would be a form of revenue. Again, it depends on the example of business that you're given. What is meant by the term sustainable sources of revenue? Well, it's a source of revenue that's able to continue in the long term. So something that your business can survive on. So the only real sustainable sources of revenue, maybe on that example I've seen there, I've shown you so far, is subscriptions and sales revenue. Maybe your investments could be sustainable in the long term. It depends on how well they return their investment. Unsustainable means that it's not going to be able to be continued in the long term. So, for example, the owner's personal investment, share capital, bank loans, you could potentially run out of them if people stop giving to you. And if you're relying on those to run your business and they're suddenly taken away and it stops, you've got a problem. They're not sustainable for the long term. Your business won't survive. What is the formula to calculate revenue? And explain ways in which a business could increase its levels of revenue. You may want to pause the video now. The formula to calculate revenue is selling price times the number of units sold. So that's the selling price of each item multiplied by the number of units that it sells. In the exam, read it carefully. look for where the data will be. Somewhere it will tell you how many items the business is selling, and somewhere it will tell you their selling price. Or it may even give you the total revenue, if they want it to be nasty, and then tell you how many items they sell, so you'd have to divide the total revenue by the number of items they sell to obviously work out then what the selling price per unit is, if I wanted to go backwards. But if they did that, then they're giving it on a plate because they're telling you what the revenue is going to be to start with. Just bear that in mind though, that it may not be just straight in your face. You might have to just look around a little bit and do a bit of reading. Take your time and do it properly. Explain ways in which a business could increase its level of revenue. A business could increase the selling price of their products, but then they need to be careful, because what would that do to their future sales? It would certainly work though, it would increase revenue. It can increase its marketing, because more advertising means that hopefully if it's done properly, it should increase the number of sales a business makes. It could possibly create new packaging to make the product look more appealing to customers, or develop new features, because that could create more demand and make products want to buy their product or service. Again, notice that most answers are valid as long as you explain why. You're just explaining ways in which a business can increase its revenue. What is meant by the term expenditure? List examples of the different types of expenditure in a business. What is meant by the term overheads? And explain methods a business could use to reduce expenditure. Again, you may want to pause the video now. The term expenditure means all the money going out of a business. Typical examples of different types of expenditure you could list could be capital expenditure. Now remember, capital expenditure, money, remember, so capital expenditure is big things, buying expensive items like your building or your machinery. That could be one type of expenditure. You could have overheads. Now they are your ongoing costs, and that's what we answered in the question below, your running costs. You could have expenditure on stock, or you could have expenditure on startup costs. They're all typical examples of expenditure. What is meant by the term overhead? Well, overheads are the everyday running costs of the business. They over your head, they're ongoing all the time. So these are costs you have to pay all the time to keep your business operational, and they just call them overheads. Explain methods a business could use to reduce expenditure. Now here, what I haven't done is I haven't explained, I've just listed them for you, so that would not be a good answer. I need to explain why, but we've done that in the past, so I'm not going to do it all over again because it seems to be a waste of time then. So you could get cheaper suppliers. That would reduce my expenditure. I could try and negotiate a bulk discount, remember. That may get me this, save me money and be able to reduce my expenditure. I could maybe relocate to a smaller or maybe a new location where I pay cheaper rent. There'd be all methods that would be valid in reducing my expenditure. Remember though, there'll be lots and lots of answers that will be valid there. As long as you explain why, you'll get the marks. Profit. What is profit? How is profit calculated? Explain how a business could increase its profit figure. Explain how a business makes a loss. You may want to pause the video now. Profit is the money that's left over after costs have been taken away from revenue. You could also get away with actually defining profit by using the formula, which of course is my next question. And profit is revenue minus costs. Or sometimes you'll see the word cost replaced by the word expenditure. So bear that in mind. If you can't find revenue minus costs as one of your options, if it was a multiple choice question and not a question where you've got to try and state it from memory, bear that in mind. It's revenue minus expenditure. Explain how a business could increase its profit figure. A business could increase its revenue or decrease its costs. That's the only two ways it can increase profit, because if you look at the formula, they're the only two variables that impact on it. So now I've got to go a little bit further. I've got to explain how I can increase my revenue. So an example of this could be increasing my selling price. So that would be increasing my revenue. Or I could find a cheaper supply of raw materials, because that would be reducing my expenditure. Again though, all answers are probably valid as long as they're explained. Explain how a business makes a loss. Seems a strange question, but it's fairly straightforward if you think about what it's asking you to do. A business makes a loss when costs are greater than revenue. And I've backed this up with a little example. For example, the costs are £100, but revenue is £80. There you go. I've explained I've explained how a business makes a loss when it actually spends more money than what it receives in revenue. Simple as that. Break even. What is meant by the term break even? Explain the benefits for a business of conducting break even analysis. Explain the potential drawbacks of break even analysis for a business. May want to pause the video now. Break even is the point at where a business is not making a profit or a loss. It's the number of units a business needs to sell before it starts to make a profit. There is the key point. It's a point where we don't make a profit or a loss. And it tells us, remember, how many units or how many items we have to sell to reach that point. It doesn't give us a figure in cash straight away. That formula gives us a number of units. So break even informs the business of how many products it needs to sell before it makes a profit. This can be used as a target for the business to aim for. Or it could be used to inform how a change in price or costs could impact on how many items we actually have to sell. So that's fairly straightforward. Think about the logical answers, because most of them are actually the correct answers that you've covered so many times. Targets. So it gives the business a target to aim for. It tells them how many products they've got to sell. And again, it also shows how a change in one factor, like a price or a cost, would impact on your business and how many items you have to sell. Break-even is typically based on an average. So in a shop, you may sell many items. So the more expensive items would skew your break-even data. It's typically based on a prediction and doesn't take into account the actions of competitors. What I'm trying to say there is, if you think logically about this, we're doing break-even, either for your small business selling sweets in school. If you sell sweets, cans of Coke and packs of crisps, your break-even will be an average figure. But you may actually sell more of one item than the other, or one item may be more expensive than another. But because it's an average, it has to take into account all three. And that doesn't make it as accurate as it should be. You could do it per item, but that then becomes time consuming. And there's another great drawback that you can use in any exam. If you get stuck for an answer for a drawback, always fall back on the time consuming. Because remember, in business, if it's time consuming, then it costs you money. Based on prediction, based on data normally from either your market research or last year, which may be inaccurate. And of course, it doesn't consider your competitors who may reduce their price. And think about the effect that will have on your product or service and how successful you're going to be and what you may have to do with your price. What is the formula to calculate break-even? What is meant by the term margin of safety? Explain why a business would want a larger margin of safety. What information will be on a break-even chart? You may want to pause the video now. The formula to calculate break-even is fixed cost divided by the selling price minus variable costs. And remember, that bit's in brackets. Now, you don't actually need to know that for the exam. They will give it you in the exam if you're doing your BTEC exam. It would be the same for GCSE exams. At A level, though, you would need to know that formula. And it's always quite handy to know it anyway. What is meant by the term margin of safety? Well, quite simply, the margin of safety is a difference between the break-even output, so what you calculate your break-even point would be, and the actual number of units a business is currently making. So, for example, if you calculate your break-even is 300 units you need to sell, or 300 cans of Coke you have to sell, but you're currently selling 500 cans of Coke, then your margin of safety would be 200 units, or 200 cans of Coke. That's all it is, the difference between the actual and where you currently say your break-even point would be. Explain why a business would want a larger margin of safety. Well, the greater the margin of safety, the better the business is performing. As the break-even point is the number of items a business has to sell to make nothing. And of course, if you think about the margin of safety, that's telling you where they currently are now, so how far above their break-even point they actually are. What information will be on a break-even chart? Well, you'd have your fixed costs, your variable costs, your total costs, your revenue, your break-even point, your area of profit, your area of loss, and your margin of safety. Label the break-even chart below. Pause the video now. That is what your break-even chart should look like. Notice that you've got your revenue line, which is the blue line that runs straight up the steep line. You've got your fixed cost line, which is straight. Notice that fixed costs do not change with output, so it's got to be the same. It doesn't matter how many items we sell, it's going to go straight the way across. Notice the costs are the same at £3,000 in this case. So we're selling more items, but we're still paying £3,000. Variable costs. Notice they start from the bottom, because if we sell no items, we pay nothing on our variable costs. But if we actually sell more items, they go up. Notice my total costs. The reason I know total cost starts from the fixed cost line is because, remember, to calculate total cost, go back and think about the formula. It's fixed cost plus variable costs. And we know that fixed costs stay the same, so the first number at 0 have got to start at the 3,000 point, because we have to pay £3,000 even if we sell no items. And it carries on from that point there. And then look at the break-even point. It's a point where the total cost line crosses a revenue line. That is the break-even point. The area of profit is that triangle that goes from the break-even point into that section between the total cost line and the revenue line. And the triangle, the other side of the break-even point, would be the area of loss. I haven't marked on the margin of safety there, but that would be whatever I put my total current level of output on there. So that might be, for example, let's draw a line from 2,000 and it goes all the way up to where my revenue line is and across there. So 2,000, using my finger, would go across at 6,000. And then that'd be the difference between that would be where my break-even point at 1,500 is to 2,000. The margin of safety, 500 units. Okay, draw a break-even chart for the business below and complete the table. Pause the video now. You should have the following answers that are shown in the table below. I'll quickly just run through how you should complete the table. I haven't drawn a break-even chart because I haven't got the same axis probably that you may have chosen to use. However, what I will do is put a link at the bottom of this video so you can see what one should look like, and maybe even give you some axes so you can actually make it simple. So to get your revenue, you had to multiply the quantity by the actual selling price. So each item obviously sells at £8. You sell no items, you get nothing. But obviously if you sell 100 items, 8 times 100 gives you 800. Let's do the variable cost column. It costs us £2 to make each item. So if you sell no items, times £2 is nothing. If you sell 100 items, times £2, it's £200. Fixed costs, if you notice, stay the same throughout because I pay the same amount of money. Remember, total cost is quite simple. It is literally my fixed cost plus my variable cost. And if I want to plug it into the formula, remember the formula, fixed cost divided by the selling price minus the variable cost. So remember the bit in brackets at the bottom has to be done first, BODMAS. So do the bottom bit first, the selling price minus the variable cost. So the selling price minus the variable cost, which means that that'll be 6,882. And divide that by the 800, which gives you 134. Analyse what happens to the break-even point if costs increase or revenue increases. Pause video now. If costs were to increase, the break-even point would increase, as if any costs, it be fixed or variable, are increasing, then the business is going to need to sell more items before it be able to make a profit. Think logically about that. If you have to pay more to buy your items in, that means that if you sell at the same price, you've got to sell a few more items to actually make more money. So if costs go up, your break-even point goes up. You need to sell more items. However, if revenue was to increase, the break-even point would fall because you're now charging more for each item. So if you charge more for each item, that means you don't need to sell as many items to make a profit. If you're unsure on this, use the formula and then change the numbers. So change one of the fixed costs or the variable costs, or change both, and change your revenue, your selling price, and see what happens to the break-even point. You watch it fall or increase, and that'll be proof of what happens. Yes, it's difficult, but it's certainly logical if you practice, and if you use the formula, there's no reason why you shouldn't be able to do this. Budgeting. Define the term budget. what is meant by the term variance. Explain the purpose of budgeting for a business organisation. And what is the difference between budgetary control and budgeting? A budget is a plan or a prediction of the revenue and expenditure within a business. Remember the key word, a plan or a prediction. The term variance simply means the difference between your budgeted amount and the actual figure your business has achieved. So it's a difference between what you budgeted and what you actually got. And the variance tends to be a figure. Remember, it can either be favourable, which is called favourable, strangely enough, or it can be adverse. That's when you do worse than expected. So adverse is worse than expected, favourable is when you did better than expected. The purpose of budgeting is it enables a business to plan its finances. So it could be able to arrange loans if they need them, if they had a cash flow problem or a liquidity problem. Or they could be used to set targets. The difference between budgets and budgetary control? Well, the budget is the plan, where budgetary control is the management of your expenditure on a day-to-day basis. So ensuring that you actually stay within the plan, the budget that you set, and adjusting the figures to ensure you hit these targets. So budgetary control is the actual day-to-day management, where the budgeting part is the plan. Explain how poor budgetary control could impact on a business organisation. And then calculate the variance for the following business. Pause the video now. If a business fails to control their spending, then they could get into debt and need to borrow money from the bank. This would come with an interest charge, which would increase the overall cost of the business. It could also be a poor sign of management, and it could demotivate your employees in the workforce, and they wouldn't work to their maximum potential, again increasing costs and maybe reducing the staff morale in the business. In the following business, the variance would be favourable by £100,000 because we were looking at the expenditure aspect, and they planned to spend £300,000 but they actually only spent £200,000, which means the business was better off by £100,000. They did better than expected. It's favourable. Define the term cash flow forecast. Explain the difference between a cash flow forecast and a cash flow statement. Explain the purpose of a cash flow statement. Pause the video now. A cash flow forecast is a prediction of the inflows and outflows of money into a business on a daily basis. So the key part there is the forecast. Forecast, think of weather forecast, prediction. And cash flow, think about the bathtub, money going in and out of business on a daily basis. The difference between a cash flow forecast and a statement is a forecast is a prediction of the inflows and outflows, whereas a statement is what has actually happened. Explain, remember that key word, explain. A cash flow forecast enables the business to plan for its future revenue and expenditure. It enables the business to spot any potential issues, and remember they are called liquidity problems. If the business is going to face a liquidity problem, then it could organise a bank loan, or it could try and get its trade receivables to pay earlier, or it could maybe find ways to increase sales revenue. Bear in mind though, that whatever you choose to do, you've got to ensure it's probably going to be sustainable in the long term. And remember that in the long term, a loan is not the option. However, in the short term, it may be the solution to sort out a short-term problem. But remember, that sort of loan, a short-term loan, is called an overdraft. State some typical sources of inflows on an organisation's cash flow forecast, and state some typical sources of outflows on an organisation's cash flow forecast. Pause the video now. You should have, for inflows, sales revenue, the owner's personal investment, bank loan. You could have subscriptions if they offer subscriptions. You could have sale of assets. You could have money from sale of shares. You could have money from investments. You could have interest repayments on the money you put in the bank. They're all valid answers. They're all inflows that possibly could run into the business. State some outflows. You'd have cost of sales, wages, rent, salary, utilities, insurance, tax, broadband, marketing costs, administration costs. Any outflow could go on there. Explain how a business could solve a potential cash flow problem. Explain how adjusting the timings of inflows and outflows could impact on the cash flow position of an organisation. You may want to pause the video now. A cash flow problem could be solved by increasing sales revenue or reducing its costs. Now remember that the only way to solve a cash flow problem is to get more revenue, so more water running into the bathtub, or to make the plug hole smaller, so to drain less water out. Now potentially I could increase revenue by increasing my selling price or increasing my advertising. Advertising I've got to be careful with though, because if I want to advertise more, it's also going to increase my costs in the short term. I could also potentially find a cheaper supplier, and that would reduce my cost. Now it could be a supplier who reduces my cost of sales, or it could be a supplier who reduces some of my other overhead costs, like my rent, for example. Or it may even be my broadband or my utilities that I could reduce. I could potentially adjust the timings of when money comes into and goes out of my business. So think, for example, I could get longer credit period from my suppliers, so I might pay them in 60 days. But then I might try and make my customers pay shorter credit terms and pay me in 30 days. That means the tap will run into my bath 30 days before I have to pay it out down the plug hole. And that will keep my cash flow positive. The next question actually asks just about that. Explain how the timings of inflows and outflows could impact on the cash flow position of a business organisation. So, in general, if you get longer terms of credit from your suppliers, that means that you're going to pay out money at a later date than when you hopefully will receive it from your customers, as long as they have shorter credit periods. So that's all about managing the number of days credit you give, if you're going to give credit. In an ideal world, you'll get all your customers to pay you in cash, but you will establish a credit agreement from your suppliers, so you might pay your suppliers in 60 days' time, but your customers are paying you cash up front. So that means the money runs into your bath straight away, and you get to keep it for 60 days before you have to pay your supplier. So that means you will have sold the stock, made your profit, your gross profit, and then you will then pay your supplier the remaining part, and the rest of it is your profit sitting in your bathtub, which you can use to invest and buy more stock. Explain the advantages of conducting a cash flow forecast to help with business planning. Explain the risks an organisation may face by not conducting a cash flow forecast. You may want to pause the video now. A cash flow forecast can ensure that a business is able to plan its future finances, to ensure that it does not have a liquidity problem. This means that it could plan if it needs to take out a loan, or it needs to sell off some of its assets, or hold a sale to increase its revenue. It could also use this to review the progress that it's made in its business over the past year and look at how the business is performing overall. It could use these to set targets or to make decisions on future ways that the business is going to tackle any problems it may face. Explain the risks an organisation may face of not conducting a cash flow forecast. Well, if a business doesn't conduct a cash flow forecast, then it could have a liquidity problem. It may not have enough money to pay its due costs, so its current liabilities, if we looked at it before. If it can't pay its current liabilities from the revenue as in the business, it may need to go to the bank and it may need to arrange an unarranged loan, or it may need to take out an overdraft. And all these things come with increased interest. And of course, the more interest you pay, the greater the costs are going to be to your business organisation, because you're just increasing the size of your plug hole, remember. It also could show that the business has got a lack of planning and a lack of direction, which could be poor management. Explain how to solve a cash flow problem. Explain why cash is better than credit sales for a business. Well, there's only two ways to solve a cash flow problem. One is to increase your revenue. Two is to reduce your costs. And of course, you could increase your revenue by increasing your selling price. You could increase your revenues by increasing spending on marketing, so you're going to actually increase your costs in the short term, but you know you're going to make it back through the increased sales that you're going to make. You could develop a new product, but again, that may cost money in the short term, but in the long term, it would increase your sales revenue. Notice that, again, I'm just giving you answers that could possibly be correct when I justify them. All it is about justification. Because I'm justifying my answer, it's correct. And I'm stating why it's correct, short term, long term. You could reduce costs. So you could get a cheaper supplier of your raw materials. You could potentially negotiate a discount to buy in bulk. But again, in the short term, you may have to spend more money to buy the stock in, but you will actually get the unit cost per item to fall. So you'll be paying less per item, and as a result, overall, in the long term, you reduce your costs. You could try and outsource your work to another country maybe and take advantage of cheaper labour overseas. Explain why cash is better than credit sales for a business. Well, cash is money going instantly into a bank account of a business, which can be used to pay for costs. However, credit sales mean that customers will get paid a period of time to pay for their product or service. This means that a business will have to wait for its money to enter the business, and it doesn't get paid instantly. So think about that logically, as we said before. When you pay cash, it goes straight into your bathtub. Whereas when you give the customer credit, like 60 days or 30 days to pay, you have to wait 30 days to receive your payment. That means you've got to find other sources of finance to cover any short-term debts and short-term liabilities that you have to pay. Complete the cash flow below. You may want to pause video now. You should have got the answer. Minus 4,000 for A, minus 4,000 for B, minus 4,000 for C, and you should have got 9,000 for D. I'll explain where the numbers come from. A. The net cash flow is effectively showing you the profit you've made each month and the net amount of money you made each month. In January, the inflows were £8,000, but the outflows were actually £12,000. So you had more outflows than inflows, so that's a negative of 4,000. The opening balance for a new business was 0, as I gave you there. So you need to find your closing balance by adding your opening balance plus your net cash flow. So you had nothing plus minus 4,000 means you close with minus 4,000. This is in brackets. Brackets symbolise the number is a negative. You could put a minus in front or you could use brackets. It's open to your choice. Number C, letter C. The opening balance. The opening balance, well, if you finish January the 31st with minus 4,000 in your bank account, you're going to open on February the 1st with minus 4,000 in your bank account. Notice the pattern. The closing balance from the last month becomes the opening balance of the next month. And D, you had to find the closing balance again. So you had to add the opening balance plus the net cash flow for April. So 1,000 plus 8,000 gives you £9,000 positive return. Analyse how that business is performing now using your data. Pause the video now. In this question, you need to use some of the numbers to try and help to support your answer because you're analysing it, you're breaking it down. Again, there's going to be no right or wrong answer. It's going to be how you justify your answer. So look at how I have picked this to pieces. The cash flow at the end of April is positive with £9,000 in the business bank account. However, in January, in February, it has minus 4,000 and minus 2,000 in its bank account. It's making a loss. This could be because the business is new and is just starting up, so it could be expected. In March and April, the business is making a profit, and this improves the cash flow position overall. Notice that I've started to break it down into smaller chunks. I've used data to support my answer, and I've made a reason why it maybe is making a loss in its first few months about being a new business. So I'm not too worried, and the losses aren't too great. However, I've also picked out that by the end, in March and April, the net cash flow is showing it's making a profit. It's got more money coming into its bathtub than is going out. So it's got a positive cash flow, and it's started to pay off its debt. It's overdrawn in the first few months, but then it's not by the time April comes. So it's started to pick up. It's showing signs of being a successful business. That's just one possible answer. just from delving into the numbers. Identify solutions to improve the cash flow of this business. Pause the video now. Again, in this question, you've got to try and use some evidence to support your answer. Again, there's no right or wrong answer. It's going to be how you interpret it and the decisions you want to draw and the conclusions you want to make. So, you could, for example, have said the business could try and reduce the startup costs in January and February because it's spending more money in those 2 months than what it's receiving. A solution to this could be that you say you get cheaper suppliers. You could have said you want to get credit from your suppliers, and if you've got 60 days credit, that's going to delay the payments of 60 days, so 2 months, which basically means the business then would have enough positive incomes going into the business to pay off its suppliers or its outflows without needing to borrow money from the bank. However, you could also suggest that the business, quite simply, actually has a greater level of inflow. So the owner, for example, makes up the shortfall. So in January and February, rather than losing £4,000, maybe the owner could put £4,000 in January, so it has £12,000 in revenue going in, or inflows, and it has £12,000 going out, so that means that the net cash will be zero. And maybe in February, the owner could put in another £12,000, and that then means they wouldn't need to go to the bank and borrow the money, and they wouldn't need to pay overdraft charges. That answer is just as valid. You could even say about trying to increase sales, or having an opening offer or increasing their advertising. Again, all answers will be valid as long as you explain why. There are no right or wrong answers, just how you justify your answer that matters. Define the term profit. State the 2 types of profit that exist. State the formula to calculate each of these types of profit. And explain which profit is greater and why. Profit can be defined as revenue minus costs, or it's all the money made by a business once the costs have been taken away from your revenue. The 2 types of profit that exist are gross profit and net profit. And remember, you need to know these formulas. Gross profit is revenue minus the cost of sales, whereas net profit is gross profit minus expenditure, or it could be revenue minus all costs. Explain which profit is greater and why. The gross profit is bigger because it only takes away the costs that are related to making the product, or the production of the product, the cost of sales. Whereas net profit takes into account all expenditure. Remember, if you want to remember it, think of gross. Gross meaning fat, grotesquely obese, big, gross. So if you've calculated your profit figures and you've got your net profit being greater than your gross profit, then something is wrong. You need to go back and check it. Remember, gross will always be bigger than net, because gross profit effectively is telling you how much profit you make from selling your products before you take away any other costs. Define the term cost of sales. Explain the impact on a business if it has a negative gross profit, so it's making a loss. Explain the impact on a business if it has a negative net profit, so it's making a loss. Keywords there are gross profit and net profit. Pause the video now. The term cost of sales means costs are directly linked to the production of the product or service. Notice they've got to be directly linked. Cost of sales, cost of producing that product or service. Again, we're talking about costs of making a product, not, for example, delivery costs or marketing costs. Explain the impact on a business if it has a negative gross profit. Well, if a business has a negative gross profit, that's quite serious, because remember, that's revenue minus the cost of sales. So that suggests that the company is selling a product for less than what it costs them to make the product. So, for example, it costs £1 to make the product, but you're selling that product for 80p. Now remember, we have talked about some products are sold at a loss for a purpose, like the Amazon Kindle. However, in a normal business, typically you would not be selling items for less than what it costs you to make it. That'd be silly. So if they're making a loss at gross profit, this is a very, very bad business. They need to reduce their costs or increase their selling price. Explain the impact on a business if it has a negative net profit. Well, again, it's not bad. It's making a loss. So it's quite bad. Sorry, I should say that again. It is quite bad that it's making a loss. However, it's not as bad as making a loss at gross profit. It just means that your other expenditure in your business is greater than it needs to be, and you probably need to think about reducing other expenditure in the business and get the other costs down to make the business successful in the longer term. Explain the purpose of financial statements. Which financial statements show the profit and loss for a business? Explain which stakeholders could be interested in the details included in these statements. Pause the video now. Financial statements are like the income statement, the profit and loss account, the statement of financial position, the balance sheet, are a legal requirement by law. So you have to produce them. In addition, these statements could be used by stakeholders to inform on how the business is performing, how much profit it's making, and where that profit is coming from. So remember that the purpose of these statements tends to be to show how much a company is worth, how much profit is it making, and it's required by law. Bear in mind that, as we said before, the profit and loss account shows how much profit it's making, where the balance sheet or the statement of financial position shows what the business is worth. Because remember, we'll come to look at how you can manipulate profit. Which financial statement shows a profit and loss? The income statement. Explain which stakeholders could be interested in the details in these statements. Well, owners typically tend to be interested in the income statement because it shows how much profit the business is making. The statement of financial position shows how much the business is actually worth. Remember the snapshot of the business, so a picture of the business at any one time. Shareholders can be interested because they want to know how much they're going to get back for the money they invest in their business. The taxman, the government, can be interested in knowing how much tax it's going to get from a company. Local community could be interested in knowing how their local business is performing to see if it's going to offer jobs in the longer term. Even your suppliers and your customers may want to see your accounts to see how you're performing as a business. Explain the purpose of an income statement. Explain the purpose of a statement of financial position. Explain what is meant by the term trading account. Well, an income statement shows the gross net profit of a business, and it shows what it's typically made over the past year. This document, though, the income statement, only shows the profit made, and it doesn't show you where it came from. So remember, if you sell off your assets to make a profit, it won't tell you that, it just tells you how much profit you made. Whereas, the statement of financial position, or the balance sheet, shows you what the business is actually worth today, taking into account their assets and the liabilities. So it shows you what the business owns and what the business owes. So if the business hasn't got many assets, but it's been making a healthy profit, then there's probably a good indication that the business has been selling off its assets to make a profit. Remember, that's not sustainable in the long term. It's all about sustainability, remember. You want a sustainable source of income and a sustainable profit. Explain what's meant by the term trading account. Well, the trading account is the top section of the income statement. The income statement is broken into two sections, but the top section is the trading account where the gross profit is worked out. That's because to work out gross profit, you need to do revenue minus cost of sales. And that is the income you get from trading, what the business typically does. So when it trades, it makes revenue, and when it trades and it produces products or service, it has to pay its cost of sales. And as a result, that section of the account is what we call the trading account. Explain why we can't just trust the income statement for the financial performance of a business. Pause the video now. Well, the income statement only shows the profit or loss a business makes. It doesn't show where the actual profit and loss has come from. For example, if a business sells off its fixed assets like its machine, its factory, and it could actually lease it back. Remember sale and lease back, where you sell it off, get a lot of cash in the short term, and then you pay out in the longer term, so that rent becomes a current liability. So you're selling off one of your fixed assets or non-current assets, and then you adopt a current liability when you're paying rent. In the short term, you're going to increase your profits. but it's not sustainable because you can't keep selling off your factory, you can't keep selling off your machinery, otherwise your business won't succeed. So in the future years, you're going to struggle. However, the assets and the liabilities of business are only shown on the financial position. So that's a statement of financial position. And that document shows how much the business is really worth at any point. And that's why you need both documents. You need to see if the business is making a profit, and then you need to see how much it's really worth. What does it really own, and what does it really owe? Where is that money coming from? Complete the income statement. So you need to work out the gross profit and the net profit. Pause the video now. You should have calculated the gross profit at being £60,000 and the net profit at being £20,000. Gross profit is income or revenue minus cost of sales. So 100,000 minus 40,000 is 60,000. And then the net profit is your gross profit minus your expenses. Now you need to add your expenses together. So you have to do 35 plus the 5 gave you 40,000 in total expenses. And then 60,000 take away the 40,000 gives you £20,000 net profit. Complete the statement of financial position. Pause the video now. You should have got the following answers. Current assets. So all the money you're owed in within 1 year. So the money you've got available, you can turn it into cash within 1 year. Physically, you can actually solve any short-term cash flow with these assets. You need to add them together. So £4,000, £6,000 and £500 gives you £10,500. Your total assets, you need to add your current assets to your fixed assets. If you add them all up, you get £40,500. Your current liabilities. This is the money you owe out within a year. All the money you owe within 1 year. What you're liable for, you're responsible for within this year. So you owe out in this business £7,000. You'll add them up together. Your working capital. Now you need to know the formula for this. Working capital is the money in the business at any one time. Now working capital is short term. So remember, you need to think about short term money in the business as current assets. And the short term debts you've got to pay within a year are your current liabilities. So you do your current assets minus your current liabilities. So 10,500 take away 700 gives you 3,500. So they've got a positive working capital. They've got £3,500 in their business, a positive amount remaining once they paid off all their current liabilities. So the business is fairly healthy. Total assets less current liabilities. Well, the word less means take away. So you've got to take your total assets away from your current liabilities, and that means a business is currently worth £33,500. And at the bottom, you've got your shareholders' funds. In other words, where's the money come from? And you've obviously got £20,000 from shareholders. And in total, you've invested £33,500 in the business. So retained profit means you must have put £13,500 in. Notice that the value of the company of £33,500, so the money in the business, is the same as what's been invested in the business. And it's got to be like that. It's how it balances. You have to have the same amount of money invested in the business as what the company is actually worth. Discuss how the business is performing. Assess how the business could increase its gross profit, and assess how the business could increase its net profit. The business is making a gross profit of £60,000 and a net profit of £20,000, which both seem healthy. However, it does not have much cash in the bank, £500, which is the best current asset, and it's relying on its trade receivables and its stock for its current assets. This could be an issue if customers are late paying, and then the business could have a liquidity problem. Also, if it wants to sell its stock quickly, then it's probably going to have to sell this asset at a cheaper price than its true value. The business also has quite a large overdraft, which has a high level of interest attached to it. However, that said, the business does have a positive working capital figure of £3,500, so it's able to cover easily all its short-term debts. Now notice the question says discuss. Discuss is a longer answer question. Probably the most challenging question you possibly could face. And to discuss, you have to show both sides. So as you see there, I've shown one side of the argument, and then I've shown the other side of the argument. And to ensure that I show the examiner I know what I'm doing, I've used some data to support my answer. Again, no right or wrong answer. It's all about just how I justified it, and I use the data to make that justification. Assess how the business could increase its gross profit. A business could increase gross profit by either increasing revenue or reducing cost of sales. This could be achieved by finding cheaper suppliers or making the product cheaper, or by increasing the selling price of the product or service. I could also achieve this by increasing advertising so that more people know about the product. Assess how a business could increase net profit. A business could increase net profit by either increasing revenue, see the above line because obviously that's what I said before, or it could reduce expenditure such as finding a cheaper building to rent, or reducing the cost of my staff wages, so outsourcing to another country where I get cheaper staff. The business could also reduce the cost of sales, which would also help the business to increase net profit. But remember, and this is where it comes in here, think about the formula. If I want to increase my gross profit, there's only two variables. So think about the formula, revenue minus costs. I've only got two options to increase gross profits, to do something with my revenue or do something with my cost of sales. Where with my net profit, because it obviously is gross profit minus expenditure, I could adjust any of my costs because net's everything. So I could do any of these options. But typically I could reduce some of my other expenses. Because obviously once I tamper with my gross profit above, I want to look at my other expenses and tamper with those to increase my net profit. But it is correct that if I adjusted my revenue or I adjusted my cost of sales, I would probably improve my net profit as well. Okay, that's it. You should now know most of the areas of weakness that you've got from what I've just discussed with you. It could be useful if you go back over these topics in the future and just ensure that you fully understand what you need to do in these topics for the exam. Don't worry if you're thinking, wow, some of those questions are quite hard. That's what the idea was. I was trying to show you some of the harder questions you may get, trying to think out of my own mind some of the more detailed questions you might get, and hopefully 98% of that you're okay with. All we need to do then is just focus on the smaller sections. You now need to practice some past questions. Attempt the quizzes on my website and just keep using your knowledge. If you were to give up now, probably an hour a night, even half an hour a night, just to revision, practicing, using that knowledge, you'll be fine for the exam. It's all about getting organised. It's never too late to pass any exam. Don't forget to subscribe to my YouTube channel, click the button below, and follow me on Twitter, it's @BeeBusinessBee. And good luck with your business knowledge.